Disclaimer.
Forget everything you think you know about market cycles. At precisely 9:30 a.m. today, the financial laws of gravity simply stopped. While the mainstream media distorts the truth with talk of volatility, the data confirms a 6 sigma event, a mathematical anomaly so rare it should only happen once every 500 million years. The system didn't just dip today, it broke. For 2 years, the Federal Reserve hid behind a $2 trillion liquidity cushion called the reverse repo facility. It was the shock absorber that kept your world from feeling the impact of a dying dollar. As of this morning, that cushion is gone. It hit zero. There's no more buffer. There's no more safety net. The plumbing of the global financial system is officially dry, and the $850 billion weapon held by the East has just been fired. This is not just about a $118 silver price or a $5,500 gold peak. It's an autopsy of the dollar. While amateur traders are hyperventilating over 2-minute candles, the People's Bank of China is executing a calculated liquidation through proxies in Belgium and Luxembourg, funneling Western wealth into physical Tier 1 collateral. They aren't just selling our debt, they are buying the exit doors and locking them behind them. If you are holding paper promises, digital claims, or the hope that the Fed will save the day, you are the target. You are the exit liquidity for the very banks that are currently $720 billion underwater. Today, we go beyond the hype. We are going into the source code of the Grand Divorce to show you why the February 27th deadline is the only date that matters for your survival. Welcome to the autopsy of the paper matrix. Here's where it gets interesting because what's happening right now goes deeper than most Americans realize. You've probably noticed something strange when you've been shopping for homes or refinancing lately. Mortgage rates are behaving in ways that defy everything we learned about how interest rates are supposed to work. The Federal Reserve has been signaling rate cuts, bond traders have been pricing in lower rates, and yet the average 30-year mortgage rate in America just hit 9.15%, according to the Mortgage Bankers Association's latest weekly survey. Let me put this in perspective for you. When the Fed raises its benchmark rate, mortgage rates typically follow. When the Fed cuts or signals cuts, mortgage rates typically fall. That's economics 101, the kind of relationship that's held steady for decades. But right now, we're watching something that shouldn't be mathematically possible under normal circumstances. The Fed funds rate sits at 4.5%, yet mortgages are trading nearly double that level. The 10-year Treasury yield, which traditionally anchors mortgage pricing, has spiked to levels we haven't seen since the financial crisis, and it's moving independently of Fed policy for the first time in modern history. Imagine you're trying to sell your house, but every single real estate agent in town simultaneously closed their doors. You'd still own the house would still have value in theory, but suddenly there's no mechanism to actually convert that asset into cash at a fair price. That's exactly what's happening in our Treasury market right now. We've entered what traders are calling a liquidity cliff. Prices are falling, not because the underlying asset is worthless, but because there aren't enough marginal buyers to absorb the selling pressure. Think about this scenario for a moment. You're planning to retire in 5 years, and you've been told your entire career to keep a balanced portfolio of stocks and bonds. Bonds are supposed to be the safe part, the thing that protects you when stocks get volatile. But what happens when the supposedly safest asset in the world, United States Treasury bonds, can't find buyers at reasonable prices? Your bond fund doesn't just lose a little value from interest rate changes. It experiences what analysts call a repricing event, where decades of assumed safety get recalculated in a matter of weeks. The Bank for International Settlements, in their latest quarterly review, noted unusual stress in what they call the plumbing of global finance, a diplomatic way of saying the pipes are starting to crack. But there's something even more unusual happening that most people aren't connecting yet. Pop quiz. What happens when you combine a liquidity crisis in the Treasury market with mortgage rates that have completely decoupled from their traditional anchors? The answer reveals itself in the most unexpected place, the commodity markets. Here's where it gets even more unusual. The dollar index, which measures the strength of our currency against a basket of foreign currencies, is rising at the same time that silver prices are surging. According to commodity trading data from the CME group, the simultaneous movement has only happened 3 times in the past century. In each instance preceded a major restructuring of the global financial order. Financial historians call it the confidence death spiral, because it signals that investors are simultaneously fleeing to the safest currency while also fleeing to the hardest physical assets they can find. Let me explain what this means for your daily life. When the dollar strengthens, imported goods should get cheaper. Your vacation to Europe should cost less. But when silver and gold are also rising, it means sophisticated investors are betting that the dollar's strength is temporary, an illusion created by everyone else's currency collapsing faster than ours. They're buying physical metals as insurance against the moment when our turn comes. Think of it like being the tallest person on a sinking ship. Yes, your head is above water longer than everyone else's, but you're still on a sinking ship. The math behind this is actually quite straightforward once you understand the mechanism. According to the Treasury Department's own quarterly refunding documents, we need to issue approximately $300 billion in new debt every single month just to fund our government's operations. That's separate from refinancing existing debt that's maturing. Now, who typically buys this debt? Foreign central banks, domestic banks, money market funds, and individual investors through their retirement accounts. But here's the problem. Foreign central banks are selling, not buying. Domestic banks are underwater on the bonds they already own. Money market funds just lost their favorite parking spot. And individual investors are watching their existing bond holdings lose value and asking themselves why they should buy more. This is what market analysts call a demand destruction event. We still need to sell the bonds. The government still needs to fund itself. But the natural buyer base has fundamentally changed, and not in a temporary way. The reverse repo facility hitting zero isn't just a number on a screen. It's the canary in the coal mine telling us that the air in our financial system has become toxic to the traditional participants who keep markets functioning smoothly. You might be wondering why this isn't plastered across every news channel, why your financial advisor hasn't called you in a panic. The answer is uncomfortable, but important to understand. Most of the financial industry operates on what economists call normalized assumptions. They build their models, their retirement projections, their risk assessments based on relationships that have held true for 30, 40, sometimes 50 years. When those relationships break, the first response isn't to sound the alarm. It's to assume the break is temporary, an anomaly that will self-correct. They've been trained their entire careers to fade the extremes and bet on mean reversion. But when statisticians see events this extreme, they don't adjust their models slightly. They throw out the models entirely and start asking what fundamental assumption they got wrong. Right now, the fundamental assumption that is breaking is this, that there will always be enough buyers for United States government debt at reasonable prices. That assumption held true for over 80 years. Today, we're watching that assumption shatter in real time. And the consequences are rippling through every corner of our financial system faster than most people realize. Now, let me show you exactly how this liquidation is happening, because the method being used is as revealing as the act itself. When you hear politicians talking about foreign holdings of U.S. debt, they typically reference Treasury International Capital Data, or TIC reports. These monthly reports from the U.S. Treasury are supposed to tell us who owns our debt and whether they're buying or selling. But here's what most analysts miss. The data only shows where the bonds are custodied, not who actually owns them. Think about this for a moment. If you wanted to sell a massive position without causing panic, without triggering headlines that say China dumps U.S. Treasuries, how would you do it? You certainly wouldn't sell directly from accounts that have your name on them. You'd route the sales through financial centers where transactions blend into the background noise of daily trading. According to the latest TIC data released just last week, we're seeing exactly that pattern emerge through Belgium and Luxembourg. Belgium is a country with a GDP of roughly $550 billion, and Luxembourg clocks in at around $80 billion. Yet between them, they're showing treasury holdings that fluctuate by $50 to $70 billion per month. Does that make sense to you? These are economic powerhouses, suddenly developing an insatiable appetite for American debt one month and then reversing course the next. They're custodial centers, specifically Euroclear Bank in Brussels, where foreign central banks can execute transactions without their fingerprints showing up in the obvious places. Here's where it gets interesting. When we cross-reference the TIC data with reports from the Bank for International Settlements, a pattern emerges that's impossible to ignore. China's directly reported treasury holdings have been relatively stable over the past year, hovering around $800 billion according to official figures. But when you add up the monthly swings through Belgian and Luxembourg custodians, track the timing of those movements against Chinese economic policy shifts, and account for the shell game of custodial transfers, you're looking at approximately $50 billion per month in systematic liquidation. Let me put this in perspective for your retirement account. Imagine you own shares in a company, and the largest shareholder starts selling their entire position. But instead of selling through their regular brokerage account where everyone can see it, they're moving blocks of shares to offshore accounts, then selling through those accounts in a way that does not show up on the company's shareholder list until months later. By the time you realize what's happening, the stock price has already adjusted, and you're holding the bag. That's exactly what's occurring with our treasury market, except the company is the United States government, and your retirement account likely holds these bonds either directly or through mutual funds. Have you checked your bond fund allocations recently? Here's what you need to understand. According to the Investment Company Institute, American retirement accounts hold approximately $7 trillion in bond mutual funds and bond ETFs. A significant portion of that is in Treasury securities and Treasury-backed mortgage bonds. When the marginal buyer disappears and the marginal seller is liquidating $50 billion per month through hidden channels, the mathematical outcome is predetermined. Prices must fall, yields must rise, and every American with a balanced portfolio watches their supposedly safe allocation lose value in ways that were never supposed to happen. But the Treasury liquidation is only part of the story. Let's talk about what's happening inside our banking system right now, because this is where the liquidity crisis becomes a solvency crisis. The Federal Deposit Insurance Corporation releases quarterly banking profiles, and the latest report contains a number that should be front-page news: $720 billion in unrealized losses on securities held by U.S. commercial banks. Think about what that means. Your local bank, your regional bank, the major money center banks that hold your mortgage and your savings account, they're collectively sitting on $750 billion in losses that have not been recognized on their income statements yet. How is that possible? It comes down to accounting rules that allow banks to classify certain securities as held to maturity, or HTM. If they intend to hold these bonds until they mature, they don't have to mark them to market. They can pretend the losses don't exist. But here's the problem with that accounting fiction. Those bonds still serve as collateral. They still back up the deposits in your checking account. They still represent the bank's capital cushion that's supposed to protect depositors when things go wrong. And every single basis point that interest rates rise erodes that cushion further. According to banking analysts at the Federal Reserve, every 10 basis point increase in long-term yields translates to approximately $12 billion in additional unrealized losses across the banking system. Now do the math with me. The 10-year Treasury yield has moved from 3.8% at the start of this year to over 4.6% today. That's 80 basis points. Times 12 billion per 10 basis points equals roughly $96 billion in additional losses just in the past few months. Add that to the existing $720 billion, and you're approaching numbers that start to threaten the actual solvency of institutions, not just their paper valuations. You might be thinking, but my bank looks fine. They're still paying dividends. They're still opening new branches. Here's what you need to understand about bank failures. They don't happen gradually. Silicon Valley Bank looked perfectly healthy until the moment depositors started asking for their money back. The bank had $42 billion in HTM securities, bought when rates were near zero. When rates rose and they needed to sell those securities to meet deposit withdrawals, they crystallized $16 billion in losses overnight. The bank that looked stable on Friday was seized by regulators on Monday. According to data from the Office of the Comptroller of the Currency, there are currently over 4,000 FDIC-insured commercial banks in America. How many of them are carrying similar unrealized losses? How many are one depositor panic away from the same fate? The answer is uncomfortable. We won't know until it happens, because the accounting rules allow them to hide the losses right up until the moment they can't anymore. But let's move from bonds and banks to something more tangible, something physical that can't be hidden by accounting tricks or custodial shell games. Let's talk about silver, specifically what's happening in the COMEX futures market that should concern anyone who understands supply and demand mathematics. The COMEX, which stands for Commodity Exchange, is where most silver futures contracts in the world are traded. Here's how it's supposed to work. Producers and consumers use futures to hedge their exposure. Speculators provide liquidity, and at the end of each contract month, a small percentage of contracts result in physical delivery. The vast majority get rolled forward or settled in cash. But there's a specific category of inventory called registered silver that is available for delivery against futures contracts. According to the latest warehouse reports published by the CME Group, registered silver inventory on the COMEX has fallen to 28 million ounces. Let me give you context for that number. Total open interest, meaning all the outstanding futures contracts that theoretically could demand delivery, represents over 500 million ounces. That's a ratio of about 18 ounces of paper claims for every 1 ounce of actual metal available for delivery. Some analysts calculate it even higher, at 356 to 1 when you include the options market and other derivative claims. Think about this scenario. You have 18 people who each hold a claim ticket for the same bar of silver. As long as nobody actually asks to take possession, the system works fine. Everyone's happy trading their claim tickets back and forth. But what happens when even a small percentage decide they want the actual metal instead of the paper promise? The entire structure collapses immediately because there simply isn't enough physical silver to honor all the claims. This isn't theoretical speculation. We have historical precedent. In the nickel market in 2022, the London Metal Exchange halted trading and actually canceled trades when a short squeeze threatened to bankrupt major participants. They rewrote the rules in the middle of the game to protect the institutions that were caught on the wrong side. According to reports from the Financial Times, billions of dollars in executed trades were simply erased from existence because allowing them to settle would have exposed the fraud inherent in the system. Now here's where this connects directly to your financial future. If you own silver through an ETF, through a brokerage account showing silver in your portfolio, or through any paper mechanism, you need to understand what you actually own. You own a liability on someone else's balance sheet. You own a promise that in a functioning market could be converted to physical metal. But in a force majeure event, in a situation where delivery becomes impossible due to lack of physical inventory, you own a claim that will be settled in dollars at whatever price the exchange decides is fair. The CME rulebook explicitly allows for cash settlement in the event that physical delivery becomes impractical or impossible. Think about what that means when we're talking about a market that's potentially 356 to 1 leveraged. If even 5% of paper holders demand physical delivery, the game is over. The exchange declares force majeure, settles all outstanding contracts in cash, and the price of physical silver in the real world detaches completely from the paper price that's been suppressing it for decades. According to the Silver Institute's latest supply and demand report, global silver production is approximately 1 billion ounces per year. Industrial demand alone consumes over half of that for applications in solar panels, electronics, and medical equipment. Investment demand has been rising steadily as people wake up to exactly what we're discussing here. At some point, the mathematics become undeniable. You cannot have infinite paper claims on a finite physical resource without eventually facing a reckoning. The question you need to ask yourself is this. When that reckoning comes, when the February 27th first notice day arrives, and we discover whether the COMEX has enough physical silver to meet delivery demands, will you be holding physical metal or paper promises? Because the people liquidating treasuries through Belgium and Luxembourg, the people who understand what $720 billion in bank losses really means, they're not buying silver ETFs. They're buying physical metal and taking delivery. They're locking their wealth into assets that can't be printed, can't be custodied away, can't be settled in devaluing dollars when the system breaks. Every piece of data we've examined points to the same conclusion. The paper financial system is running on borrowed time, and the borrowed time just ran out. Now, let's talk about why this isn't going to get better, why there's no policy solution that fixes what's broken, and why the math itself has become our enemy. The United States Treasury just released their monthly statement, and buried in the numbers is a data point that should terrify anyone who understands compound interest and exponential functions. We are now issuing $1.2 trillion in new debt every 100 days just to service the interest payments on our existing debt. Let me make sure you understand what that means. This isn't money for Social Security, for defense spending, for infrastructure, for any government program that actually does something. This is purely interest expense, the cost of servicing debt we've already accumulated. According to the Treasury's own fiscal data, our national debt stands at approximately $36 trillion. With average interest rates on that debt now exceeding 4%, we're paying roughly $1.4 trillion per year just in interest. That's $117 billion per month, or about $1.2 trillion every 100 days. But here's where the math becomes a death spiral. To pay that interest, we have to issue new bonds. Those new bonds also carry interest. So next quarter, we're paying interest on the original debt plus interest on the new debt we just issued to pay the interest. Mathematicians call this a Fibonacci sequence, where each number is the sum of the two preceding numbers. In finance, we call it a debt trap, and there are only two ways out: default or inflate. Think about your own finances for a moment. Imagine you have a credit card with a $100,000 balance at 20% interest. That's $20,000 per year in interest expense. Now imagine your income isn't enough to cover the interest, so you take out a new credit card to pay the interest on the first card. Next year, you're paying interest on $200,000. The year after that, $320,000. Within a few years, you're bankrupt. That's where we are as a country, except the numbers have 12 zeros behind them instead of 5. According to the Congressional Budget Office's latest long-term projections, interest costs will exceed defense spending this year and approach $1.7 trillion annually by the end of the decade. But their projections assume interest rates come back down to historical averages. What happens if rates stay elevated because foreign buyers keep liquidating through Luxembourg, because the reverse repo stays at zero, because the fundamental bid for our debt has permanently changed? The projections become meaningless, and the debt spiral accelerates beyond anything the models can capture. Now here's where this connects to silver and gold in a way that most people aren't seeing yet. When governments get trapped in debt spirals, they have historically chosen inflation over default every single time. Why? Because default means admitting you can't pay, which destroys your ability to borrow in the future. But inflation allows you to pay back your debts in currency that's worth less than when you borrowed it. It's a hidden default, a stealth tax on everyone holding your paper. The problem is that inflation destroys more than just bond values. It destroys the social contract, the trust that holds societies together. When a $20 bill that used to buy a week's worth of groceries only buys 2 days' worth when your salary that felt comfortable 3 years ago now leaves you struggling to pay rent, people start looking for alternatives. They start asking what money really is, what holds value, what can't be inflated away by government printing presses. This is where the 40-to-1 ratio becomes crucial to understand. For most of modern financial history, the ratio between gold and silver prices has averaged around 60-to-1, meaning if gold trades at $60 per ounce, silver trades at $1 per ounce. But that ratio isn't based on the actual physical abundance of these metals. According to the U.S. Geological Survey, silver exists in the Earth's crust at a ratio of roughly 15-to-1 compared to gold. Above ground, the ratio of available silver to gold is estimated at around 8-to-1 because silver gets consumed in industrial applications while gold gets hoarded. So why does silver trade at 60 or 70 or even 80-to-1 compared to gold? And the answer lies in the paper markets we discussed earlier, the suppression mechanism that keeps physical prices disconnected from physical reality. But throughout history, during periods of monetary crisis, that ratio compresses. In 1980, it hit 16-to-1. In 2011, it touched 32-to-1. The long-term average across centuries of human civilization sits at around 40-to-1. Now do the math with me. If gold is currently trading at $4,800 per ounce, a 40-to-1 ratio would put silver at $120. But here's where it gets interesting. Gold itself is undervalued when you consider the monetary expansion that's occurred. The traditional formula for gold's inflation-adjusted price, accounting for the total money supply, suggests a fair value north of $5,500 per ounce. At a 40-to-1 ratio with gold at $5,500, silver's mathematical fair value becomes $137.50 per ounce. But that's just the baseline reversion to historical norms. What happens when you add in the supply squeeze we documented earlier, the 356-to-1 paper-to-physical leverage on the COMEX, the industrial demand that continues to grow while production struggles to keep pace? According to proprietary models run by precious metals analysts, a short squeeze scenario where even 10% of paper holders demand physical delivery could send silver to $200 or higher before equilibrium is restored. Some technical analysts, looking at historical blow-off tops and momentum patterns, have targets as high as $300 per ounce. You might be thinking, those numbers sound crazy. Silver at $300? That's 10 times the current price. But let me give you some historical context. In 1979, silver was trading at $6 per ounce. By January 1980, during the Hunt brothers squeeze combined with inflation fears and geopolitical uncertainty, it touched $50. That's an 800% move in less than 12 months. What we're setting up now has all the same ingredients: monetary crisis, supply shortage, geopolitical tension, except the leverage in the paper markets is exponentially higher than it was in 1980. Have you noticed what's been happening to silver prices over the past few months? While mainstream financial media focuses on stock market fluctuations and crypto volatility, silver has been quietly grinding higher. It broke through $28, consolidated, pushed through $32, and is now testing multi-year highs. The move hasn't been dramatic enough to make headlines yet, but that's how these things typically work. The smart money accumulates quietly before the explosive move that gets everyone's attention. According to data from precious metals, dealers, and mints around the world, physical silver premiums have been rising steadily. The premium is the amount above the spot price that dealers charge for actual coins and bars. When premiums rise, it signals that physical demand is outstripping supply, even while the paper price remains suppressed. Some dealers are reporting premiums of $5 to $8 per ounce above spot for common products like American Silver Eagles. That's the market telling you that the paper price and the physical price are starting to separate. But here's the critical date you need to understand. February 27th. That's the first notice day for the March COMEX silver contract. First notice day is when futures contract holders must notify the exchange if they intend to take physical delivery instead of rolling their contracts forward or settling in cash. Historically, only 1 to 3% of contracts result in delivery requests. But if we see even a modest increase in delivery requests, if 5 or 7 or 10% of contract holders stand for delivery, the exchange will face an impossible choice. They can either drain their already depleted registered inventory to meet delivery demands, which would trigger a cascade of additional delivery requests as traders realize the game is ending, or they can declare force majeure, settle contracts in cash, and in doing so, admit to the world that the paper market was a fraud all along. Either way, the suppression mechanism breaks, and physical silver detaches from paper silver in a way that creates a two-tier market: the fictional paper price that settled in increasingly worthless dollars, and the real physical price that settled in whatever the actual supply and demand dynamics dictate. Think about what this means for your financial positioning. If you own silver ETFs, you own the paper version. You own the promise that can be cash settled at the exchange's discretion. If you own physical silver in your possession or in allocated storage where specific bars are earmarked for you, you own the real thing. The difference between those two positions on February 28th could be the difference between having wealth and having a dollar-denominated IOU that buys a fraction of what you thought it would. Now, let's address what comes after the break. The Federal Reserve and the U.S. Treasury aren't blind to these dynamics. They understand that a crisis in the Treasury market or a default in the commodities markets threatens the dollar's reserve currency status. They've been preparing contingency plans, and those plans involve capital controls and central bank digital currencies. The infrastructure for CBDCs already exists. The Federal Reserve has been testing platforms. The technology is ready. All that's needed is a crisis significant enough to justify implementation. Capital controls mean restrictions on moving money out of dollars or out of the country. They mean limits on how much gold or silver you can buy, how much you can transport, how you can store it. Look at what happened in other countries that faced monetary crises: Argentina, Venezuela, Greece. In each case, capital controls were implemented not to protect citizens, but to trap capital inside the system while it devalued. The government's priority during a crisis isn't your wealth preservation. It's maintaining their ability to borrow and spend, even if that means confiscating your purchasing power through inflation or explicit controls. This is why the preparation window is closing. This is why waiting until after February 27th, waiting until after the delivery default becomes public knowledge, waiting until everyone else realizes what's happening, that's waiting too long. By the time capital controls are announced, by the time CBDC implementation becomes mandatory for accessing government services or conducting transactions above certain thresholds, the exit door is locked. You're inside the system with no way to protect yourself from what comes next. But here's what I want you to understand, and this is crucial. This isn't about fear. This isn't about panicking or making rash decisions. This is about recognizing that the game has changed, the rules are different now, and the strategies that worked for the past 40 years aren't going to work for the next 4. The people who thrive in the coming environment are the ones who understand what real wealth means. Not digits on a screen, not promises from institutions that are $720 billion underwater, but tangible assets that hold value regardless of what happens to paper currencies or digital ledgers. Response to the day traders. And let me speak directly to those who think they can trade their way through this. While others are distracted by 2-minute candles, they are missing the forest for the trees. You cannot trade a system whose plumbing is dry. When the reverse repo hit 0 today, the casino lost its floor. If you're playing with paper ETFs or leveraged futures, you aren't an investor. You are exit liquidity for the very banks currently failing. In a world of 9% mortgages and 0 liquidity, profit is a secondary goal. Sovereignty is the only one that matters. The difference between someone who's wealthy and someone who's financially secure has never been clearer. Wealth can be measured in dollars that are being printed into irrelevance. Financial security is measured in assets that can't be printed, can't be confiscated digitally, and can't be settled in devaluing currency when the system declares force majeure. This is the autopsy of the dollar. We've examined the corpse, identified the cause of death, and documented the evidence. The liquidation through Luxembourg, the banking system's unrealized losses, the COMEX's mathematical impossibility, the debt spiral that mandates inflation, the ratio reversion that targets 137.50, the February 27th deadline that marks the point of no return. Every piece of data tells the same story. The paper system is ending, and what comes after will reward those who understood the difference between paper promises and physical reality. The choice is yours, but the window for making that choice is measured in weeks, not years. Welcome to the other side of the grand divorce.